Okay, good morning, everybody. Thank you for joining us again. It's been a really exciting 3 months. We're almost towards the quarter end, and it's been market dominated by two T's, Trump and tariffs. And today we are at our part two of Go the Distance webinar, and we're going to talk about 3 months in a couple of things. First and foremost, what our learnings about, the impact of US policies, and maybe something a little bit more closer to home, a little bit in terms of Asia, China, and we'll share a little bit more in terms of our outlook for the next quarter. And we've also have Arthur from GAFCAL, founding partner and head of research, who'll talk a little bit about how resilient are the markets. Okay. Let me just introduce the speakers now. Yep. So today we've got two key speakers for our session today. Tony is our head of multi-asset strategy at UOB Asset Management. We've having this kind of conversations for a couple of months, years. But I think over the last 3 months, you've probably seen one of the most exciting markets, a lot of changes and relatively dynamic environment. Arthur's the founding partner and head of research at GAFCAL. I think he provides a lot of insight on China, and I think today we're going to talk a little bit more about the impact of these policies in China, China itself as an economy, and the future way forward. Okay. So we're going to start a little bit with Tony today, and I'm going to get Tony to cover a few key questions. And maybe I'll do this in the format of our Q&A. Okay. Maybe Tony, coming into the two T's, Trumps and tariffs. What have we learned about the US economy 3 months into the Trump presidency? And is there a real risk of recession or even stagflation?
Okay, thanks, Shankar. So yeah, I think we've been learning a lot in these early months of the year. So just to recap, at the start of the year, we had a couple of key views that we were using as we were deploying our assets in various investments. So one view was that the global economy looked to be in pretty good shape to us. We liked the trajectory of the U.S. economy, which had survived this period of high inflation and high rates, and interest rates were being moderated. And we thought, all the more evidence that if it could survive the past couple of years, then we're all the more confident in a year where interest rates are coming down. The U.S. consumer looked solid. Solid job creation, solid wage growth implied a lot of spending power that made us confident about the economic outlook in the U.S. And just to add on, other regions that were kind of weak last year, like Europe and China, did look like they're stabilizing and getting a bit stronger into next year. So I'd say that was one key view, that we liked the economy. And then secondly, that we were adopting a view that the Trump policies were potentially problematic, but we believed a couple things. One, that the economy was strong enough that we didn't think we thought Trump had probably 12 months before you'd actually see anything really in the economy to see evidence that it could slow down. And then secondly, that after the legacy of his first term, I thought there was evidence that he cared a lot about the stock market. He cared a lot about juicing the economy. And ultimately, even though the stated policies were problematic, we didn't think that he would go so far as to really risk hurting the markets that badly. And so what we've learned is a couple of things, that that the assumptions look like they're quite challenged. So firstly, I think Trump's policies are more aggressive than expected, and he appears to be much more willing to tolerate significant market drawdowns and significantly hurting the economy, much to a greater degree than we've seen in the past. And then secondly, I think what we learned is this economy is not quite as durable as were originally thinking. So we're already seeing some signs that there may be weakness in the U.S. economy in particular. Let me share a couple of slides just to, I guess, give context to, I guess, how we're thinking things. So firstly, when it comes to GDP around the world, I think we've highlighted that, overall, we have the consensus of economists around the world. We're seeing continued expansion. And so we have continued growth. But there are a couple things to note, that we're starting to get downgrades in the US, and other regions in the world look like they've been kind of sluggish, like Europe and Japan, and look like they're improving. In Asia, looks like it's remaining pretty solid. but like so in particular, if you look at the oops, if you look at the U.S. economy, I'd say what is happening is economists around the world are sort of reevaluating their assumptions on how durable the U.S. economy is and what the effect of these policies are. And so, for example, I would say this is a forecast from Goldman, and I think it's kind of typical of what we're seeing from a lot of economists, where you're getting a downgrade in the economic forecast for the U.S. And I think there's a couple spins here. You could say on the positive side that, this is just a moderate step down, and that, the forecast here is still for continued expansion. On the worrisome side is that, actually this happened really quickly. Just a month into his presidency, we started to see some cracks of weakness already and had to start to downgrade. And there's a risk here that, as we get more information over the next 6 months, we may be thinking about even a weaker trajectory. I think, Shankar, you asked, are we considering, is this a recessionary outlook? And, our answer is no. Our base case is still for continued expansion, but we're sort of downgrading some of the growth assumption. We maintain like a checklist of things that we tend to see before a recession. We look at things like the yield curve, the behavior leading indicators. We look at recession probability models, financial stress, the high yields versus investment grade spreads, et cetera. But I mean, the main takeaway here is we're just not getting that many warning signs of recession yet, right? So I still don't think it's right to say that recession risks are that high. But what I do think is right is that at the start of the year, I would have given recession risk very low odds. It didn't. It seemed like if we survived the last couple of years, where I was at times kind of worried about the recession risk, I didn't think the risks were that high at this stage. So, but what has changed is I think we have to acknowledge that if I was, say, giving it a 10% chance of a recession at the start of the year, I think my assessment is closer to like a 30% chance now, and hence we have to deal with that higher uncertainty.
Thanks, Tony. So a lot of the soft data is kind of leading the markets, and here hard data has been a little bit more stronger. So do you think that this will continue to lead the markets, being the US markets, to stay volatile? And do you see a time frame? Do you see this buying opportunities, or do you see this as a situation where clients have to probably reallocate their US allocation somewhere else?
Yeah, so the market call on this is obviously very tricky. I think we have to acknowledge that the uncertainties are much greater than we were assuming at the beginning of the year, and that the ripple effect into the economy is greater, more uncertain than we were thinking at the start of the year. So we have downgraded our overall view on equities. We're calling it more of a neutral view. I'd still say there's a path for, a rebound if maybe the policies turn out to be a little less aggressive in the end once they get announced on April or whatever. And I think it's also possible that we do see that, there is a fair amount of durability in this economy. But nevertheless, the uncertainties are great enough that we had to downgrade at least to neutral. And also then, I think in particular in the US, I think it was somewhat to our surprise that the negative effects of all these policies at the start of the year, we were assuming it would start to hit some of the other global markets more. We kind of saw that pattern in the first presidency term of President Trump. That when those policies were implemented, we saw Asia struggling more over that period than say the U.S. was. But I think the evidence is kind of the opposite this time. The U.S. seems to be getting hurt more in terms of the downgrades to its economy and also the downgrades to earnings. So I would say overall, I don't think we mean to take an overly bearish view on global markets. But when it comes to the U.S. in particular, because it has this, higher valuation and, essentially the markets have been giving it a very low risk premium. I think we're in a world where U.S. equities are seeing sort of faster downgrades to that earnings forecast, and at the same time, the markets are giving it a bit more of a uncertainty risk premium that's leading to sort of a more cautious view on the U.S. equities.
Thanks, Tony. So I'm mindful that in our global asset allocation, especially in the equities, we've seen an increase both in the European equities as well as the Asian equities. Do you see this as potential long-term opportunities, short-term opportunities, And are there markets that will see contagion effect from the US here?
Okay, yeah. So we have adopted the view that that regions such as Europe and Asia, we do think actually are more attractive now, and we are comfortable to overweight it. And this, I really think is for at least the medium term. And I'd argue what big picture is going on is that, those growth differentials that have made the U.S. so attractive in recent years, with the companies there doing so well and really leading the way in terms of earnings growth. Now that you're seeing the US get downgraded somewhat and those other regions getting upgraded some degree, and there's such a big valuation gap, I do think it makes sense that we sort of reassess this sort of continued US overweight that we've had for actually several years in a row. And so we are transitioning our portfolios and recommending to clients to lean more into European equities, and Asian equities. And in particular, we think, China equities are looking more attractive, and we have a bit more confidence that compared to the sort of the short-term rebounds that we've had in China, we actually think the one-year outlook is looking more attractive.
Thanks, Tony. So it's a little bit glass half full, glass half empty kind of thing. It's also it's an issue about balancing risks and where you find other opportunities outside there. So one of the things that I realize here in terms of our outlook, in terms of the fixed income, bar high yield, I think we've been relatively stable in terms of our outlook. When you talk about fixed income, maybe we can have a little bit more nuanced view. What about US, Japan, Europe, and Asia? And if you are a investor in this space and you want the stability that bond markets give, where are the main opportunities that you see here? Yeah.
Okay, yeah. And to recap, for a while now, we've been arguing that we really like that this interest rate normalization that we've seen over the past year has made fixed income more attractive. And, we've had this dialogue with many clients who still sort of feel the aftershocks of 2022, where fixed income struggled. And we've been arguing that actually fixed income at these interest rate levels are actually really attractive and should be part of people's portfolios. And then specifically to your question, I guess is okay, then where? And so all along we've been highlighting is that we like the US and Asia as being markets where we see interest rates as being the most normalized and we're most comfortable with. But other parts like Japan and Europe, where interest rates were still low, we were a little bit more cautious about. But recently, European rates have started to normalize as well. And I think a big message we keep giving to clients is, over recent years, I think investors have sort of always sort of looked for fixed income driven by policy when, central banks are going to, do QE or they're going to cut interest rates. We'd argue that we shouldn't really be counting on central banks to drive our returns in fixed income. We should invest it for the good yields. And then so places now, I would argue it's sort of Asia and Europe actually, I think are starting to be more attractive.
So essentially, Tony, bonds behaving like bonds again. Uh, is there a particular focus on maybe hard currency or local currency?
So at the start of the year, we were more focused on the hard currencies, and so I'd say what we have seen is that the global economies have looked fairly stable, and as the growth differential has changed, I think that's made global investors more confident in local currency. So I think that's sort of back on the table as being a legitimate option.
Yeah. Speaking and staying on to the currency point of view, a lot of returns are all relative and in many cases all relative to the US dollar. What's our view on the dollar, especially against the major currencies in this region? Yeah.
Okay, so we do believe that the US dollar has peaked. And but it has stepped down enough already that our view is that we expect the U.S. dollar to be somewhat range bound with sort of a weakening bias. And the currency view depends a lot about these uncertainties coming up. And so if in fact the growth outlook becomes more recessionary, then ultimately that we still believe will create a sort of flight to quality that probably strengthens the dollar in the end. But that's not really our base case. Our base case is that we kind of just have a step down, a little bit more sluggish period of growth. and that we're getting sort of weaker U.S. differentials compared to the rest of the world, where the U.S. is getting downgraded a bit more. And that leads to hence this sort of kind of like weakening trend in the U.S. dollar.
Thanks, Tony. I will come back to you in terms of the Q&A, and maybe I just want to get Arthur's thoughts and all. And I think one interesting thing, and we talked about Trump tariffs, the other part of it that we talk a lot about these markets, or at least in this region, is China. And, Arthur gets a lot of points of views from China, and I wanted to have a couple of ideas that we speak a little bit about. Hi, Arthur. Good morning. Maybe let's start. Oh, sorry, Arthur, you're on mute. Hi. Yeah.
Yeah, hi, how are you?
Yep. Hi. So Arthur, from a outlook point of view, let's start with China from the outside looking in. Everything is about tariffs and everything is about the economy. How is this impacting the Chinese markets? Given the fact that it's Trump 2.0, it's kind of a known thing that they will be having these considerations. Has China have become more resilient, and how would this impact their economy going forward? Yeah.
Right. Okay, well, thanks very much. And I'm very pleased to have this opportunity to share some thoughts with you today. So thank you for the invitation. Um, yeah, I mean, I think so. I've spent the last 10 days in Hong Kong, Shanghai, Hangzhou, and Beijing talking to people. And I think the overall perspective that I'm getting is that number one, people are quite concerned about what will come from on April 2nd from the tariffs with Trump. They think this will be a problem that China will need to manage. And there's a high degree of uncertainty, as Tony was saying, about what exactly it's going to be here. And I think the uncertainty more than the thing itself is really a part of what's causing the problem. But I think there are two other things going on. One is that there is a sense that China is very resilient, probably better prepared to take on tariff hits than they were 7 or 8 years ago. And on a relative basis compared to the rest of the world, if you think about it, the first Trump trade war was mainly about China. So China has now had several years to adjust to this. The rest of the world has not, and so China is a little bit ahead in terms of figuring out how to deal with this. Um, and second, then there's just a tremendous amount of optimism about the developments in the tech sector, which were catalyzed by DeepSeek. There's kind of an I don't know if you want to call it gold rush going on, but there's certainly a rush to pour out AI models and see how those can be applied. This has been very beneficial for the big tech platforms, which are well positioned to take advantage of this. We just got the announcement today that CATL, the big battery maker, has received Beijing's approval to do its IPO in Hong Kong. I anticipate that will also be a catalyst for improved sentiment there. So you have, I think, a sense that it's going to be rough sailing for China, but there's some resilience. The tech story is very positive, and I think the missing link, frankly, is the domestic consumption story. So outside of China and in a couple of cities in China, everyone's very excited about the tech story. But inside of China, the big word that people are using is a Chinese word called neizhuan, which is a little bit hard to translate, but basically it means excessive competition and too many players in the market driving down profits to zero. So you have real difficulties in companies generating high profit margins. This means that they're reluctant to take on new employees. This means the labor market is still quite soft. Households look at that and they say, I'm going to be very cautious in my spending because I don't really see a big opportunity for income gains. So you have a little bit of a negative confidence cycle in domestic consumption, which the government has not succeeded in breaking out of yet. So that's, I think, probably the biggest single challenge for Chinese policy this year is actually not so much the tariffs. I mean, that will be one, but the bigger challenge is can they do enough to really get domestic consumer spending in a more positive trajectory?
Thanks, Arthur. We talked about the tech sector a little bit, and I guess the DeepSeek movement, in which they define it everywhere now, is starting to make a material change. And you talked a little bit about this. Maybe Can you explain what you're seeing in the Chinese markets, one? And two, maybe can you explain a little bit further what are the big guys doing in the market? And three, do you see similarities on this maybe compared to what happened with Nvidia and the major chips in the US maybe 2 to 3 years ago? Yeah.
Well, yeah, I think it's a little bit different than the NVIDIA story because that's fundamentally a hardware story. And what people in China are focused on is essentially what DeepSeek did is it said the cost of developing a large language model was a lot less than people were thinking 6 months ago. Uh, and so this is, I think, done two things. One is now you have every company in China with any capacity at all on these things releasing its own large language model. So there's kind of this competitive race there. And most of that is going to lead nowhere, right? You have a couple of really strong models from the likes of Alibaba, um, Tencent, and so forth that will do well. Um, but the game is not in the models themselves. The game is in the applications that are built on top of that. And I think what people are really getting excited about is now that it's very cheap to create this model, uh, that input cost has gone way down. And so if you're a big platform, and again, you're basically talking about the Alibabas, the Tencents, the Meituans of the world, ByteDance. Um, you have a much lower barrier to building AI enabled applications that you can then push out to consumers, right? And I think the concept is very clear. The specifics, I think, are not so clear, but people are kind of taking on faith that there will be a lot of sort of consumer facing applications that will be very interesting built on these cheaper LLMs, and that's really what's driving the excitement. So it's much more of it's basically a return to favor of the internet platforms that were everyone's darling throughout the 2010s, then got hit by this regulatory firestorm, and now they are positioned to ride the AI wave to new prosperity. And the government has basically said that's okay. We're not going to get in the way of that. And so I think that's really the key story there.
So Arthur, the next point you talked about is this word, Meituan, and the consumption trends, and as well as deflationary environments in China. Maybe you can explain that a little bit more. And does that mean that there's these two engines that are a little bit different? If you've got the tech engine and everybody's excited about it, and hopefully
Right.
something comes out of it, and then there's this other part of the economy that's kind of stuck in this environment. Maybe you can expand it a little bit more. Yeah.
Yeah, okay. And so I will now use this opportunity to share a couple of slides that I have that address this topic. Um, okay. Um, so I think as sort of a key thing to observe here, and I'm kind of linking the domestic um, tech story, and here I'm talking a little bit more about the hardware side of it. With the trade picture, right? And so I think this is a very important story for understanding what's going on in China, both in the positive and the negative sense. And it's a little bit complicated, so let me work you through that. Basically, what we're looking at here is the import prices into the U.S. from different trade partners of the U.S., right? And there are two lines for China. And there's the China before tariffs, which is the underlying cost structure of Chinese companies. And there's China's after tariffs, which is the dashed line up here, right? And so what you can see is that there's a big gap between the solid and the dashed line. So the tariffs on Chinese goods coming to the US have raised the prices of Chinese goods in the US by quite a lot. But if you look at the underlying cost structure of Chinese companies, it's incredibly competitive. Chinese companies have been able to keep their baseline costs lower, not just than Europe or Japan or Mexico, but also below the other Asian developing country markets. So the cost discipline and efficiency of Chinese exporters is really extraordinary. And that's one of the reasons that the first trade war didn't, in the end, have that much impact, because companies responded to that by really doubling down on efficiency. And then the other striking thing is that even when you add in the tariff effect, you can see that these really bumped up the Chinese prices for a while. But then over the last couple of years, because of these efficiency gains, even including tariffs, Chinese import prices into the U.S. have gone up less than Mexico, less than the European Union, and yet less than sort of the weighted average of all Chinese American industrial trade partners. So again, this tells you that in the hardware side of the Chinese economy, things like new energy, industrial automation, electronics, all of the things that we associate with China, they are very, very good, right? And so this is important for the tech story because I think what this tells you is that China is very efficient in producing stuff. They have this manufacturing sector that fundamentally is not going to be hurt that much by tariffs. So if you look at this, this is China's exports in red, just in dollar terms. I'm sorry, it's an index based on 2017 values, right? And then blue is China's share of global exports. And what you can see, and this is the first Trump trade war. And what you can see is that after the first Trump trade war, China's share of global exports actually went up from around 13% to around 14.5%. Right now, I'm not predicting that if China gets 60% tariffs next week, that their export share will continue to rise. But the point is that even in the face of these higher costs imposed by tariffs, Chinese exporters were able to power through, expand their market share. And so now you've got this very powerful manufacturing ecosystem in China, which is expanding into new areas, things like semiconductors, industrial automation, and so forth. And this is complementary to the kind of the software artificial intelligence story. So that's very positive, right? The negative side of this, however, is what you're saying is basically Chinese companies are very, very good at lowering their prices. So they have been. And so we now have a very, the most entrenched period of deflation really in China's history over the last 40 years. I mean, even after the Asian financial crisis in the late 90s, the deflation, economy-wide deflation, did not last as long as it's lasting now. And you can see this is mostly in producer prices. This is the blue line. The consumer prices are still hovering around zero. So overall, you don't have a serious consumer price deflation problem like you did in the late 90s or after the global financial crisis. They're kind of stable. But in producer prices, it's very negative. And as I said, this is acting as a disincentive to companies to hire, and this is feeding into negative consumer sentiment. So here, just a final slide on this, there's a tight correlation between the employment market and income growth, right? So what you see here is the employment PMIs are continuing to be very, very soft. This means that income growth is probably going to be quite soft for another quarter or two. And as long as income growth is soft, I think it's going to be very hard to convince Chinese consumers that they should get back in the game and start spending. So there's a strong linkage, I would say, between the positive story of Chinese manufacturing, Chinese tech, very good. These companies are, really globally competitive. That's excellent. But the flip side of that same coin is that this is contributing to an environment of continuously lowering prices, a very weak job market, and some problems in consumer confidence domestically.
Thanks, Arthur. So that's interesting. How do you balance this situation, right? We've talked a little bit about rates and currencies and debt. How does the Chinese government then come in and play a part to say, okay, look, this is what we want to achieve, the 5% that has come out in the recently, and how do they balance everything together, and what tools do they have in their box to kind of smoothen this position to something that maybe translates positively to the markets?
Yeah. So I think, they've kind of revealed their toolbox. They started doing that last October when they put in all of these economic support measures. And I think, the market reaction to these has been kind of back and forth. So the initial reaction when you got the first announcements in October was, oh, okay, great. Chinese government is coming in. They're going to stimulate a lot. The economy is going to be reflate. It's time to buy. And so you had a couple months where things were very positive. And then the impact of these measures wound up being a little less than people had hoped. And so then there was a bit of a pullback. I think that's still where the domestic markets are, is we're not convinced that the government is really going to stimulate as much as we would like them to, basically. I think there are a couple of factors going on here. So what the government's been very clear is, if you look at the package of measures that they put in place last October and have been rolling out since, they cut rates to some degree. We think they have room to cut rates more because on an inflation-adjusted real basis, rates are still quite high in China. They're among the highest in the world, actually, in real terms, among major economies. So they, in theory, they could cut more, but they're cautious about that. So they did some rate cuts. They did some direct support for the property market and for the stock market. And they promised a bunch of fiscal measures. And the fiscal measures were essentially formalized at the National People's Congress session that ended earlier this month. And so this is, a pretty significant increase in fiscal spending to finance, refinancing of local government debt, to give the local governments a little bit more breathing room, recapitalize the banks, start to clear the inventories of unsold properties from the market, and some things for consumer subsidies and stuff like that. I think the issue here is that the government has been very careful, because they don't want to repeat what they thought were the mistakes of the stimulus packages in 2009 and in 2015, which they thought just exacerbated the problems of excessive investment in property, local government, fiscal profligacy, and so forth. So every time they roll out fiscal measures, they want to make it very clear to people that they're not going back to the old days. And a lot of what they're doing, for example, in the local government finance refinancing, it's not actually new spending. It's just essentially rolling over all old debts. So the multipliers of that are going to be very, very low. So, and they've also been very reluctant to do kind of direct consumption stimulus. They've done a lot of these, trade-in programs where you can take your old appliances or cars or whatever, trade them in and get a subsidy for buying a new one. It's been somewhat effective, but it doesn't really address the underlying confidence problem that is holding back consumer spending, right? So I think on the plus side, what they have very clearly signaled is they wanted to support growth at or above the level that it was at last fall. So in other words, they put a floor under growth, and they've essentially said, if we're worried that growth is going to go below that floor, we will come in with more stuff, right? And I think that's fairly important signaling. That's a big change from what we had before. And what it means is that the balance of risks in the Chinese economy are skewed towards the upside, because the government is essentially put in this put option at the bottom and said, whatever happens, we're not going to let it fall below X. And I think that is what is, partly behind some of the market optimism that you see, is that if you have this floor under growth, then actually you're going to be paid to take a bit more risk than you were previously. And there's, if you look at China versus the US, I think there is huge uncertainty now about what the risks in the US economy are going to be. How bad is it going to get? No one really knows what the government's tolerance for lower growth is. It's a big mess. Whereas in China, it's very clear. They have stated what their bottom line is. So in terms of what they could do in addition to what they've done so far, I think the evidence we have from the data is that they probably need to do more to stabilize the property market. That's been part of their measures. That's a big part of the problem, obviously, is that you've had a big collapse in the property market. Households have seen their main store of wealth shrink. And basically what you see now is that people are still very reluctant to buy properties from developers. They will buy secondhand properties on the secondary market because prices there have fallen quite a bit more, and they don't have to worry about the property not being completed because it's already there, right? But until you get stronger performance in the primary market and more stability among the developers who are still facing pretty significant cash flow problems, I think that's going to be hard to get consumer confidence up. So that's, I think, one key thing that they could do is be a little bit more convincing in terms of providing support to the property developers, getting that up. On the consumer side, people talk about, well, maybe they should do more subsidies, like, for example, paying people to have more babies, that kind of thing. And I really don't think that that's the key issue. The key issue, as I've suggested, is that people don't like their employment and income prospects. And so they're looking ahead at stagnant or falling incomes, and they said, I'm not going to spend more money. So the really key thing, I think, for the government to do is restore private sector business confidence and do some things to attack this problem of excess capacity that keeps driving profits down. And once you get stronger private sector business confidence and they start hiring again, I think that then feeds into stronger consumer confidence. So that would be my wish list, is a little more effective support for the property developers to stabilize that situation, and some real efforts to improve the operating environment, the profitability environment for private companies, so that they can start investing more and hiring more.
Exactly. So let me just summarize that. So ultimately, it's probably moving in the right direction. The policies are a little bit more nuanced compared to 2019, 2015, and it's a little bit more, okay, let's keep let's keep we are able to address issues, but it's going to be addressed one by one, and it's going to be very specific, as opposed to a wide range kind of thing. And in that sense,
Right.
that gives some long-term optimism. But in the flip side here, there are obviously issues that the Chinese government still needs to address. Maybe I just want to raise one more thing. There's this question about where China is today, and there's this comparison between China and Japan. And what's your thoughts with
Yeah.
yeah.
Okay. This was a topic. I have to say, a lot more people were talking about this like a year ago.
Yeah.
Is China the next Japan? Is it, going for a lost decade? As things have started to pick up, that's faded a bit, but I still do get the question, right? And the deflationary dynamics and the high debt and so forth mean, I think, that will keep coming up. So it's important to raise that. So it so happens I have a very simple slide on this, which I will share with you. Three reasons why China is not Japan. um, and I have a pretty strong view on this. And I want to preface this by saying I think the deflationary problems are quite significant in China. I think the government is not doing enough to address them. And so this is a major macro challenge. I also believe the medium and long-term debt situation is not good. Local governments have a huge problem there. So these are real problems. So I'm not trying to say China is like fine and there are no problems. But I'm trying to say that there's a big difference between China today and Japan 30 years ago. A lot of people just say, oh, there's a lot of debt, there's deflation, therefore China equals Japan. It's like, no, it's more complicated than that. So here are three reasons why China today is very different from Japan circa 1990. Number one, the background asset price inflation was way less severe. Equity prices in Japan rose sixfold in the 1980s. The CSI 300, the equity price index for China between 2010 and 2020, depending on what endpoint you take, rose no more than 15%, maybe 0%. So there was no kind of domestic equity price bubble. Land prices, it's difficult to find comparable numbers, but basically, land prices in Japan, again, depending on which subset you take, rose between triple and sixfold in the 1980s. And most comprehensive land property price increases in China suggest that the land price appreciation was less than 100% over the course of the 2010s. Obviously, in some markets, it was much more, but if you look broadly, it was much less. So Japan had just a gigantic asset price bubble problem in 1990, and China does not. China has problems overbuilding and excess leverage and so forth, but it's not a asset price bubble where asset prices have to correct by 80% in order to normalize. So that's point one. Point two is that the asset price problem in Japan was made worse by the fact that you had cross shareholdings between banks and corporations. The corporations share prices were basically supported by their land holdings rather than their earnings. So everything was based on these very high land prices. And because the companies and the banks own shares in each other, when the shares of one went down, the shares of the other went down too. And so as corporate Japan went into this collapse, financial Japan also went into collapse and was unable to expand lending. China has never permitted cross shareholdings, and what this means is that the leverage problems are fragmented. So property developers, terrible leverage problem. Local governments, terrible leverage problem. Some local banks tied to local governments and property have a debt problem. The general financial sector does not. They've been able to massively increase their lending to manufacturing over the last 2 years, even as the property prices have collapsed. So China does not have a integrated balance sheet, and so it has much more leeway to continue to invest in profitable growth enterprises than Japan did in the 1990s. Huge difference. And then the final point is simply industrial Japan came into the 1990s very well adapted to the pre-internet economy, but very poorly adapted to leverage the internet economy of networks and so forth. If you look at China today, what is the equivalent industries in 2025 of the internet in 1993? And that would be artificial intelligence, new energy, and industrial automation. And these are all sectors where Chinese companies are at or close to the global frontier. They're very good. So not only is there a lot of ability to finance new investment in China, but Chinese companies are pointed to really, really important global growth sectors. So on those grounds, China has a lot of problems that they need to deal with, but they're not going to turn into Japan.
Thanks, Arthur. So maybe this is a short summary. Ultimately, interesting times in China. Maybe there is at least a put in place to make sure that the economy stays relatively stable. But there are challenges, and it's a little bit more nuanced. And let me get Tony on, and we maybe answer. We can get a Q&A session for this. Okay. Tony, so maybe this is the first. We've got a list of questions that participants provided a little bit earlier. So maybe let me ask this a little bit about the equity markets. What are the expectations for the rest of the year in terms of returns in the equity markets? And Euro has done relatively well year to date, and do you see more legs on that? Yeah.
Okay, how about let me just start off.
Sure.
I think we're kind of working on the assumption that the first half is still looking quite questionable. I think the uncertainties are so large, and we can no longer make the assumption that we can really sort of guess where these policies are going. We can't really guess that there's some sort of Trump put that he'll reduce things if the markets are down a certain degree, I think. So I think for the first half, I think there's a lot of headwinds. I'd still be somewhat optimistic that, the U.S. economy is a big, vibrant economy, even dealing with some headwinds. I think we could be talking the second half of the year, talking about the strength and durability of a large part of the economy. But I do think these overhangs are going to be big for at least, the first half. The other part of your question was, do we look at other regions? I think that's one of our biggest conclusions. I do think what's going on in Europe is worth investing in, and in China, I think even more so. I feel like it should be a big focus for us.
Tony, I'll stay Tony with this. Tony, is there specific sectors that would do well in this uncertainty?
Yeah, actually, we've had sectoral views since the start of the year, and actually, it's really gotten quite messy and confusing. And so, quite honestly, I don't have strong convictions on the sectoral views right now. We're just kind of thinking just more broadly about our broad asset classes.
And so maybe the next question is an interesting question, and I quite like this question. And maybe I'll ask both Arthur and Tony. Maybe I'll start with Arthur. So in this area, which is the most critical risk do you see besides tariff matters? Yeah.
Do you want to start, Arthur?
Yeah, I'm kind of scratching my head because we've been obsessing over tariffs so much. What would be the critical risk? Yeah, I mean, it is the case that I think that the tariff uncertainty is just like so much more of an issue, and because there's second and third order effects that come from that in terms of retaliation, slower growth, not just in the U.S. but in potentially other countries as well. So that really does overwhelm everything else. Um, I guess I could point to a couple risks. One is, if you look at China. I think both Tony and I have kind of suggested a kind of a cautiously constructive view there. I think you could say, maybe the deflationary problems deepen, and so then the government is forced to do a lot more sort of direct fiscal stimulus than they are anticipated doing right now. I would say that's not a very high probability thing. Um, I think the other question, the other area of sort of uncertainty that we have that is very strong lies in the Middle East, and specifically on what Trump administration policy towards Iran will be and how that will affect global oil markets, because essentially they've taken a maximum pressure view there. We saw this strike on the Houthis, which is part of that strategy. The optimistic view is that this will either, at a minimum, contain Iranian sort of pressure in the region, keep things under wraps, at a maximum, bring the Iranians back to the bargaining table so that you can get some kind of a regional agreement. I think that's quite unlikely, frankly, but you can hope for that. But the flip side risk is that something goes awry and that you wind up having, much more pressure on global oil markets as the result of destabilized politics in the Middle East. So I think I would probably put that as the other, not because I think that I would rate it as a very high risk, but it is out there. I think people are distracted from it right now, and if you have things that conspire to drive the oil price a lot higher than it is now, that obviously would have a lot of negative impact.
What about our house views here on this?
Yeah, so I would generally point to just economic risks in general. I feel like what we've done is we've taken away a little bit of this safety net cushion that we've had in global growth. And I think we're susceptible now to new things that may pop up, a banking problem or whatever. I think the economy is a little bit less buffered for downside risks. The other thing I'd point to, and I guess sort of similar to what Arthur's saying, is just that you know, Trump has gone a long way to reshape the whole world order. And I think we're not really sure of those ramifications. The U.S. used to, provide this global security blanket. U.S. had a high priority in making sure there were no wars or border aggression around the world. And I think that's gone. And I think the ripple effects, which I don't think will happen, this year or any time immediately, but I think the ripple effects for what risks will be in the world in the coming decade have changed pretty significantly.
Yep. Thanks, Tony. So Arthur's a question here, and I think we kind of alluded in this conversation a little bit. What's your thought in terms of has China really pivoted away from a different kind of economy? Are they moving into a different? Are they playing a different role in this kind of markets, both politically, economically, and how does that kind of merge together with their NPC announcement to hit that 5% GDP growth?
Yeah, I would say, if the question here is, has China pivoted to a fundamentally different way of organizing its economy, different growth model? I'd say the answer is absolutely not. As long as I've been working on China, this is now coming up in 35 years, um, they have used investment as the focus. The question is always, how do we mobilize resources to invest in the right things that will give us the biggest return? And their perspective has always been that if you do that, then eventually consumer spending and the demand side will follow, right? So it's investment first and consumption later. And I really see no evidence that they have changed that fundamental orientation. They're making a tactical adjustment. They're saying, yeah, we do have a bit of a demand problem. We need to get more consumer confidence going. And so we will pay more attention to that. But the fundamental idea um, that they're going to try and organize their economy around the changed that much. I would say the other way in which you could argue that they have an opportunity for a pivot is more kind of geopolitical. So, Tony highlighted the risk that the U.S. seems like it may be withdrawing from some of its traditional roles of providing security and the demand source of last resort, so forth. And in principle, this opens an opportunity to present itself as we're the stable, reliable partner. We believe in globalization. We believe in free trade and investment. We will step up and be kind of the reliable anchor of the global system. And they haven't really done that because they're still sticking to a model where they assume that they can run extremely large trade surpluses forever, and it's everyone else's job to buy their stuff. They're adjusting a little around that, but they haven't given up the fundamental idea. And they've, I think, missed an opportunity to soften their diplomacy and make themselves look like good guys. They've appointed a wolf warrior diplomat to be their main envoy to the European Commission. They sent some warships to circle around Australia after the Australians did something they didn't like. So they're really not doing a great job, in my view, of positioning themselves as a sort of a kinder, gentler China that will take the same reassuring role in global markets that the United States has traditionally had. It's not terrible for them. They're clearly, I think, picking up some diplomatic points because the U.S. is such a chaos agent at this point. But I think they could do a lot more, and they're missing some opportunities to, really, step up their role as a sort of a guarantor of the global system.
Staying on China, Arthur, what's the view on this? There's always this conversation about the renminbi and the dollar. Do you see that as a path that the renminbi will continue to be relatively weaker, or is there a material change in terms of how the currency is positioned? Even from an international trade point of view, does it become a more tradable currency here?
Yeah. Well, okay, so take the last one first. I think the problem with sort of the whole renminbi internationalization agenda has always been that for its own reasons, China needs to maintain very tight capital controls to maintain the stability of its financial system. As long as that's the case, it's very, very difficult for the renminbi to really to function internationally in the same way that the dollar or any of the other alternatives, the euro, the yen, the Swiss franc do. It's much more constrained. I don't see much change there. But in terms of the valuation, what's been very clear over the course of the last 6 to 12 months is that the central bank has been trying to hold a very hard line. You will not let the dollar renminbi rate go past 7.3. That is the firm line. They've been intervening very, very aggressively to make sure that line is held. And what's interesting is that they've continued to do that even when they faced an additional 20% tariffs from the United States. And I had thought that if tariffs came on quickly, they would respond with some currency depreciation to offset that. They've not done that. I think the reason is that they still think that there is, potentially a deal to be done with Trump. If they depreciate now, that will be seen very negatively. That will sort of inflame opinion in the U.S., so that's not helpful. So I think as long as there's still the possibility that Trump and Xi could get together and start some kind of negotiation process, I think they will be very firm in maintaining that level of the renminbi. I think if things break down and the U.S. and China are not able to come to agreement, and you get a lot more tariffs on China, and there's no clear pathway to an agreement, then I think the gloves come off and they say, okay, we're just going to have to let the currency adjust to absorb some of this tariff impact. But I think they're very reluctant to let that to use that weapon right now. So I would say over the next few months, Trump and Xi, the earliest they could meet, I think, would be June. There's some talk about a meeting then. And I would bet, for the next quarter, basically, the Chinese will continue that currency policy. They might get a little bit of help if you start to see some capital inflows based on this tech enthusiasm. I wouldn't hold my breath around that. And then I think it just becomes a function of, are the U.S. and China seem to be heading to some kind of a deal or not? And then you have two different paths.
Okay, I've got two last questions. Maybe Tony, the second. What about within the ASEAN markets? Do you see what is the role that ASEAN markets play in these kind of things, and would tariff impact us, and are we going to be a key beneficiary within these conversations? Yeah.
Okay, so yeah, we do like Asia markets. We had always had sort of a quick rule of thumbs that we like ASEAN and Asia in general when China looks a bit more stable and when the US dollar is not overly strong. And I think we're getting that as a backdrop right now. ASEAN hasn't been overly strong, but stable enough, and we would expect, marginally improved growth. And that it has a domestic demand in this region that doesn't have to be overly reliant on U.S. demand, and therefore we continue to like the ASEAN markets in our Asia view.
Okay, I've got one last question for both Arthur and Tony. So beyond this, what's the long-term implication? Who are the big winners, given where the markets are heading and what we're seeing over the last maybe 3 to 6 months here?
How about, yeah, let me start off because I almost want to like pose this to Arthur. So I
Sure.
think Arthur said it right earlier when, we're both sort of cautiously optimistic on China. But I would admit, Arthur, I kind of self-censor my view. I actually have this bullish view in the back of my mind that I try to calm down. And maybe I
Okay.
guess if you could, talk me down from my excitement. So I think, as we watch this, these change in, the new world order and so forth, I like one of the things that stands out to me is this is a Trump's kind of trying to create a world where the strong countries have the biggest advantages, right? So that he can start to take
Right.
advantage of people.
Right.
And so that
Right.
that does stand out. I think China becomes one of the biggest beneficiaries. Also, yeah, I think this is a world where you want to be a big country and you want to invest in big countries a little bit more so
Yep.
than smaller
Yep.
countries like you have before. And then additionally, I think China's, I mean, Arthur, you made some good points. I still think China's looking good in all this. They are looking like the more elder statesmen in all this, while Canada and Europe are outraged by the U.S. and giving sort of really sharp rhetoric back to the U.S. China's been sort of calm and stable, and they look like they thought this
Yeah.
out, prepared beforehand. And in places like Africa, where the U.S. is pulling their aid, it's not like China has really stepped in, but they are looking like the more reliable partner to present to many
Yeah.
parts of the world. And then on top of that, we've had these structural advantages in China that have always been there. It's the better valuations, the huge advantages in industry that have led to the big surpluses in trade. It has a big domestic market. It has huge advantages in technology and all these EV areas. And bond yields are low. Its currency is undervalued. It just seems like it's all adding
Yeah.
up that I think China is more than just a flash in the pan, strong quarter
Right.
right now. And so anyway, that's a little bit of the excitement that I do sort of self-temper because there are legitimate
Yeah.
reasons to be a bit more cautious. But I'd
No,
say
totally. No, I think those are great points. And when you put them all together, it's a very compelling case. I think on each point, you're absolutely correct. Um, and so China does have a lot of strength. And I think just from the standpoint, just like of U.S.-China trade negotiations, I think this is not very well understood in Washington. I think one of the problems that we have here is that there is a belief in Washington and people around Trump that China is this very weak position, and so the U.S. has a lot of leverage and they can force them to do stuff. And I think they're totally wrong, essentially for the reasons that you've suggested, right? So I think one key variable here is how does the U.S. choose to play its hand, and do they really get as aggressive as Trump has suggested that they might, or do they sort of face reality and say, "Oh, actually, this is a lot tougher, and so we need to be more careful about that." Um, but I guess I would put, I agree with you, and I think when you add that with the sort of the government put option, you can construct a strong case for China. I guess here are the cautions I would put around that. So most of the things that you talked about are, why China can continue to maintain, pretty decent economic growth, high rate of investment, technological progress, and so forth. Totally agree. How much of that is going to be translated into returns for investors from the outside? That's always been a challenge. in China is that you've often seen periods of very high growth without a super clear way of getting investment returns, particularly from direct exposure to the Chinese market. So that I would say that's kind of the challenge is if you agree with all of that you just said, how does that translate into specific investment cases? Because what you see in the tech sectors, the hardware tech sectors right now is, yeah, very good performance in terms of production, razor thin profit margins, a lot of difficulty in generating really robust growth in earnings per share. So that's, I think, a question mark there. The other thing is like, by our estimate, the true budget deficit in China is around 10 or 11% of GDP this year when you add in all of the non-budgetary government expenditures, right? So what they're saying is basically we want to support 5% GDP growth with an 11% budget deficit. Like, how long can you do that? So I think what that just says is that the headwinds from these kinds of negative consumer sentiment things are still pretty strong. And that, again, I think is a challenge for investors because generally speaking, where investors have made money in China is when the consumer has been, buying a lot of stuff and you can buy the best consumer plays. And that's essentially where you make your money. And right now, the consumers are very, cautious. To flip back sort of to more your bullish view, what you could say is like, we're just waiting for whatever the catalyst is. And when that catalyst comes, then there's a lot of money sitting on the sidelines from the consumers that could pour in and things could get much better, much more rapidly. That is an upside risk that's out there. So I guess I'm sort of 55% in agreement with your with your construct there.
Okay. Thanks, Arthur. Thanks, Tony. I think it's a really exciting session. Maybe just to summarize this, let me just share with you our current outlook. We think the expansion is going to continue. There's going to continue to be risks, like what Arthur and Tony talked about. And we are recommending kind of a balanced view. We've taken down our outlook on equities. We're a little bit more cautious on US equities from a valuation point of view. We think that there are interesting opportunities in Europe. There are interesting opportunities in Asia, ex-Japan, especially from a stock-specific opportunities. Fixed income, we think it's going to be a very important play for your portfolios. Gives you stability, especially in this kind of market environments. Bonds behaving like bonds and yields are relatively attractive. I want to take some time to thank you to Tony. Thank you to Arthur. So if we go to the next slide, you can actually see our if you need any additional questions and you need any additional information, please feel free to contact us. Come to the website, and just a reminder to add us in LinkedIn. We'll see more conversations like this, and we hope to see you in 3 months' time for our series 3. So I want to thank Arthur, Tony, and thank you for your time for joining us today. Thank you very much.
Pleasure.
Thanks for joining us, Arthur. Great chatting with you.
Great.
Thank you.